So talk about the sector in general. What's your take on financials? Where are they? Where are they headed?
Well, we are structurally bullish on banks at Wells Fargo Securities. Balance sheets are the strongest that they've been in a generation. You've had a permanent structural risk reduction. Thank you, regulators. Regulators have forced banks to increase capital and liquidity, and now banks can withstand not just one financial crisis, but two financial crises, and that's based on the Fed's own data. Having said that, it's not just the risk reduction. Revenues have been somewhat flattish this decade, and we think revenues are poised to break out, a combination of the headwinds, the biggest headwinds, biggest non-credit headwinds in the history of U.S. banking, now over. In addition, a few interest rate hikes helps, and this is all before any big benefit from lots of rate increases, deregulation, or some sort of reflation trade. So you have revenues and returns going higher, risk going lower, and it's a paradigm shift for valuations when that happens.
Now, does that positive outlook distribute evenly across the sector, and particularly when you talk about big money center banks as opposed to regional banks, as opposed to community banks, is it equally beneficial?
Well, over 3 years, we see 1/3 upside for the bank group in general. But for our top recommendations, we see 1/2 upside over 3 years, and that's generally for Citigroup, Bank of America, and JP Morgan.
So the big guys.
The big guys. This is the moment of the big guys. Think about it. In the 1990s, 1994 is when you had first ever national banking. But then the big banks didn't fully integrate the acquisitions. You had the tech bubble burst. Then last decade, you had some more acquisitions, and then what happened? The financial crisis. Lots of this decade, the big banks were cleaning up from the financial crisis. Now, for the first time since interstate banking relief in 1994, the big banks can focus on being a national bank. They can retool their operations. And one more thing, and they're not doing other bank acquisitions. They're not distracted. This is the time of the big banks finally doing what was promised from 1994.
Here's what I don't get. Mike, you come here, you don't have a prop. Last time you were here, you had a big bank.
That's right.
You're really subdued. You got a little jazzed up there, but pretty subdued. What is Wells Fargo doing to you?
Look, this is week 6 at Wells Fargo Securities. I will say there's 30 individuals analyzing financial companies in research, bank, non-bank, fixed income, and equities. And I launched on the banks yesterday, so this is my debut at Wells Fargo Securities. But I collaborated with about a dozen different individuals in research as part of my launch, so I love having the resources
Working
around.
together, how does that feel for you, Mike?
Yeah, you think I'm a lone ranger, but I love relying on other people's expertise to make a better call when I can.
So you're liking it? You're liking it over there?
Week 6, so far so good.
So far so good.
Even though there's one big bank you can't cover?
You know, I've covered the industry for a long time, and the market cap is well over $1 trillion of the companies that I cover. I have a lot to do.
Yeah.
Fair point. The big issue coming, I feel like, with banks in the next year or so is deposit beta. Like, who's going to be the first mover, and what does it do to margins? Where do you stand on that?
Well, the negative is that the margin decline this decade at the banks is the biggest it's been in 80 years. And that's a function not only of lower interest rates, but a buildup of cash on bank balance sheets. Bank and near cash has increased from $1 trillion to $2 trillion since before the financial crisis. So margins have been impacted by many factors. Now, when you look at the 10Qs, the detailed financial statements of the banks, banks generally think that deposit betas are around 50%. So far, it's been a lot less than that. And for the listener out there, for every 1% increase in interest rates, how much do deposit rates increase? I'm not getting a lot in my bank account, a lot more since the Fed raised rates. And I value the convenience. I value a lot of other factors there. But I think deposit betas stay lower for longer just because banks have so many other linkages with consumers, mobile banking and everything else. So it's a different environment. And the crazy non-bank players aren't there the way they were before the financial crisis. You've gotten a lot of the crazies off the streets, and now it's a lot more rational as an industry.
So that means you wind up, so what's your estimate for margins then? Who's going to benefit the most if they wind up charging more for their short-term loans and their deposit beta stays pretty low?
Well, I think the industry as a whole benefits from higher rates. I had an aha moment. But
not the curve, just the short term. I'm talking like not even the curve, just like the short-term rates. What's the upside for margins?
Well, in terms of specific banks, Bank of America certainly is a huge beneficiary of higher interest rates. Mostly U.S. focused, $1 trillion of deposits. And this decade alone, talk about the benefit of being a large bank. Bank of America has grown deposits organically this decade equal to the size of the 6th largest bank. That's all organic. That's what we're talking about. Large banks are getting it done. Customers are valuing, some of the services that they provide.
So let's talk about another big bank that you think is getting it done, and that's Citi. You're pretty positive on Citi, and a lot of it is because of the potential for buyback at Citi. I mean, you have a remarkable projection here. They could buy back as much as a third of their equity over the next 5 years. Is that basically because of deregulation, because the regulators are going to back off and let them deploy the capital that way?
Well, let me be clear. I think Citigroup, is getting the job done, but I also think Citigroup's not getting the job done enough. So they're getting the job done. When I talked about the structural risk reduction in the banking industry, Citigroup has reduced its risk structurally more than any other large bank. And part of that is the increase in capital and liquidity by over twice from before the financial crisis. And they've built up enough capital now that they have a lot of capital returns. We think over 5 years, Citigroup can buy back 1/3 of its shares. I've never seen a bank be able to do that. And that's a function of the strength of its balance sheet, the amount of its capital, but also the inexpensive valuation. When have you seen that before? So they've gotten the job done. Mike Corbat, CEO, eliminating a lot of risk at that firm. This is probably the lowest risk profile you've seen in Citigroup, since the merger with Travelers. On the other hand, where they're not getting the job done, return on equity is still lousy. And until they can generate returns on equity above the cost of capital, until they stop destroying value, then the heat should be on Citigroup management to better improve those returns. And one point that we make in our report, maybe they should consider a restructuring 2.0. They say the restructuring's done. They have $46 billion of tax credits, or the technical term is deferred tax assets. They think that will go to $40 billion, in 3 years, but $40 billion is still too much. So I'd like to see new ways that they can better use those tax credits. And if they do so, by their own projections, they'd be closer to getting their long-term target.
So talking about management under pressure, that leads me to Goldman Sachs. So I spoke to Lloyd Blankfein last week. We talked about FICC. Their FICC trading revenue down 40% in the second quarter, beaten out by Morgan Stanley for 2 straight quarters. This is what he had to say to me about FICC.
Much money, so that was wrong. We didn't perform well in FICC. FICC is a risk business. We don't always perform well. That being said, other firms who are operating in the same environment did better than us, and so we are on the balls of our feet. We're of course concerned about it. In my 35 years doing this, there've been periods a lot longer than this period where we've underperformed only to outperform. We know what we have to do, and we're doing it. And it's a big, it's an execution matter for us. And guess what? That's what we do.
What do they have to do?
Well, I think what's remarkable is, the CEO of Goldman Sachs is saying they have an execution issue. You haven't heard the CEO say that. The CFO said that in the second quarter earnings call. I don't remember when management said they're underperforming. So I think the intensity at Goldman is higher than it's ever been since the IPO. They haven't been in this position too often. I think still think Goldman is 2/3 full versus 1/3 empty. The 2/3 that's not trading, investment management, investment banking, securities servicing, they're lending more. The 1/3 trading, that's under some pressure. So, the market could bail out Goldman Sachs. So part of that collaboration I'm doing at Wells Fargo Securities, I relied on our fixed income research group, which is #1 in II magazine for the last 6 years. Best fixed income research in investment grade for 6 years in a row. So let me.
My God, shameless plug.
Shameless, but but that's one reason why I'm here, because I'm able to use this research. On Tuesday, the interest rate strategist said he thinks that volatility will increase by 1/3 by the end of next year. In the last 3 days, look, VIX has had a year high. If volatility increases in markets, which capital markets player do you want to own? That would be Goldman Sachs. Having said that, Goldman cannot rely on the market bailing them out, despite our fixed income research team's forecast. They need to get the job done. They've done it this decade, even with flat revenues. Look, they've bought back 1/5 of their shares. They improved the pre-tax margin by 1/3. So if the revenues don't pick up, then they'll have to do more on controlling expenses and buying back stock.
There's more to FICC than just fixed income. There's also commodities, and Goldman struggles some on that. And we actually, ironically, had Jeff Curry on from Goldman Sachs, who was saying there are technological reasons why the volatility in commodities may not come back.
So,
which is very different, by the way, if I can piggyback. With Lloyd is talking more cyclical with commodities,
yes.
And then that was a much more structural argument.
Yes, exactly, that it doesn't come back.
Well, one thing that Goldman Sachs is doing differently, they are evolving in what we say from FICC to FAC. And FICC is fixed income currencies and commodities, and what we said in our report, FAC, they're doing a lot more financing, a lot more lending. The A is for asset manager clients. The C is for more cash securities instead of derivatives, and the other C is more corporate clients as opposed to hedge funds. So they're still serving those markets, but they've evolved some from FIC to FAC, so they're not sitting on their hands.
Which Lloyd did point out he did want to shift more to a corporate mix because of that. Mike Mayo, super great to have you. Next time I want props, a little bit more energy from this side of the table. Mike Mayo of Wells Fargo Securities.